Hello, everybody. Welcome back to Everyday is Saturday. I'm Matt Stahl, along with my partner, Brad Gatto. And today we have in store for you, we are revisiting a book review we've been doing over the past several weeks. And for those of you that have not yet listened to those, we're going to be on chapter 4 today. I would suggest you go back and listen to the first 3 chapters so you can follow along with us. But the book is The Psychology of Money by Morgan Housel. And I think Brad's exact quote is something along the lines of, I wish I would have written this book.
100%. Book reviews that can sound boring.
It can.
And it's not.
It's not boring, I promise. Stick around. It's going to get exciting.
Yeah, this is it's a super fun book. This is we're not going through this in every episode, but we're kind of sporadically adding these in. And so to Matt's point, there's 3 other episodes out there where we go through the first 3 chapters of this book. So go check those out if you haven't listened to those already. This will still make sense. If you have not yet listened to those, it's not going to, you can pick up today and it makes sense to this because each chapter kind of stands alone. But if you enjoy this one, for sure go back and listen to the other ones.
And stick around for the coming chapters.
How many are there?
You tell me.
I see what you did there. The answer is 20.
That was going to be my guess. It's 21. So I didn't remember. Should have gone with a nice round number. Before we jump into that, what have you been up to, man?
It's end of the year as we record this. It's December, and there's a lot of positives about the end of the year. Mm-hmm. I'm one of those weird people that really gets into resets.
So am I.
And lets the calendar define them, even though you should be able to just reset at any time, any day.
Right.
Like you shouldn't wait until some specific, a lot of times I'm like, well, on Monday, I'm going to do that kind of deal. So the beginning of the year is always an opportunity for me to kind of do some of the bigger resets. Usually has something to do with diet. I'm not one of those people that eats food for sustenance. I eat food because I really like it.
Bologna.
Bologna. Are you calling me a liar or are you saying that I...
No, I'm saying you enjoy bologna.
I don't.
Go back.
You got to go back
and listen to that podcast.
I don't even like bologna. You ever heard the Jim Gaffigan when he talks about bologna?
I don't think so.
He's like, the bologna with the olives in it. Who's that for? Who came up with the spelling for bologna? Bologna. He's like, that's the same person as Colonel. Colonial. All right. Anyway, we derailed. So anyway, it's the end of the year. So I've got kind of that stuff going on in the holidays, but it's also my least favorite season. It's starting to get cold, like cold, like Minnesota. This last weekend, we had a basketball tournament on Saturday, and I think it was 3 degrees.
Yeah, it was
when I left my house. When it starts getting to the point where the dew builds in your windows because you have any humidity in your house, it starts to like condensate. That's where I just get mad.
We draw the line.
Yeah, that's the hard line in the sand. So I'm going to be crabby about that. And the fact that, the sun goes down at 4 in the afternoon.
Yeah.
When is the winter solstice? Isn't that coming up? Like
21st, I believe.
Okay.
Yeah.
So soon. We're getting close to that precipice where the days will start to get longer again. But the bad is it's winter. The good is some resets coming. I love that week between Christmas and New Year's. It's one of my favorite weeks of the year. I was joking about this in our team meeting this morning because I'll go on a vacation. I did this year. I went on a vacation to Hawaii with my family and I worked while I was there. But that week between Christmas and New Year, for whatever reason, I can mentally shut down and feel okay about it. I don't feel like I'm letting people down or like, so I always look forward to that week because it's kind of a nothing week in the corporate world.
Yeah.
How about you?
Well, I share the same thing, which, we've been working together on and off for 15 years now?
Sure.
Yeah. So I think we've both shared that same thing. We've always enjoyed the holidays and enjoyed that reset and enjoyed that week. So I feel the same way about that. I happen to enjoy the winter because
you're weird.
I do not like the 3-degree days. I'll make that clear.
Or -30.
No. Yeah. That's too cold.
Yeah.
But one activity we do as a family is snowboarding, and it's something we can all do together.
Yeah.
So as opposed to me just going to watch the kids play soccer, here I get to actually participate.
So for the listeners, you have 4 kids. Your youngest, Adeline, is how old?
She's 4.
And she snowboards?
She does. We kind of just strap her to a board and she just goes straight down the hill.
Is that like, should you be reported to CPS for that?
No, we have a little harness for her. She's
a harness?
Yes. She doesn't go on the big hills yet. So we stick to the bunny hill.
That's awesome. Well, awesome. Let's get into this. This book's super fun, which is why we chose to, over time, go through every chapter of this book. Morgan Housel, the author of the book, just did a wonderful job of putting together. Every chapter, again, kind of stands alone, but there's these kind of financial principles, kind of 20 financial principles that he calls the psychology of money. And this week, we're going to get into this confounding compounding. Matt, what does that mean?
Confounding compounding. So the subtitle here, which I think is going to explain all of it, is 81.5 billion of Warren Buffett's. I think we've all heard of Warren Buffett.
No.
81.5 billion of his 84.5 billion net worth came after his 65th birthday. And the point is, our minds are not built to handle such absurdities. So we've talked about this a bit in the past, with a couple thought exercises that just illustrate, as humans, how incapable we are of actually processing this.
Well, and to kind of add to that point, and just to, if you weren't writing those numbers down at home, as when Morgan wrote this book a couple of years back, his net worth was 84.5 billion dollars. All of it but $3 billion came after his 65th birthday. So he was worth $3 billion on his 65th birthday. Now he's worth 84.5 billion. And actually, 2 years later, because he wrote this book in 2020, at the end of, I can't remember the statistics, end of last year, but sometime this year. But bottom line is he's worth well over $100 billion now, like 119 billion or something like that. So
that's crazy.
3 billion before he was able to accumulate, and that's just a ton of money before his 65th birthday. But since then, it's 30x, 40x almost.
Yeah. So that's the snowball effect that starts to illustrate just once this thing gets going, just how much that compounding. The bigger the number, the more the compounding. So
what we're going to try to do is to really drive this point home, because in our world, Matt, patience is hard anyway, with anything in life. Chiefest of sinners here, by the way. I am a highly, highly impatient person. And we live in a society where everything's just right at your fingertips. It's hard to wait for anything. But when it comes to investing, the point that Morgan's trying to get across in this chapter, we're going to break this down, but the point he's trying to get across is time is your greatest asset.
Yep.
Not your allocation, not the trading that you're doing, not anything like that. That ultimately time is your greatest asset. And he uses Warren Buffett as kind of his key figure to define this. Because Warren Buffett, we should probably look. How old is Warren Buffett today?
I don't know. He's got to be in his 80s.
He's got to be in his mid 80s. We'll figure this out for the podcast.
Yeah, we should probably know that number.
All the pre-work we do before we lead into these.
Right.
Anyway, he started investing.
Oh my goodness. He's 92 years old.
92.
Wow.
And he started investing when he was like not even a teenager, like 10 years old.
Yeah. There's a great book. I think it's called Snowball. About a biography that's really, really fascinating.
Yeah. Anyway, he uses Warren Buffett to kind of drive this point home. And the point is, he's been investing for a couple of years now.
Just a few.
Yeah. 82 to be exact. That we just found out.
I love the way that Morgan takes us through this, because I'm a big fan of multidisciplinary thinking, which just means he's using an example that's not related to money at all.
Yep.
To get expand our minds and think about it. And he's talking about the discovery of the Ice Age, or the point at which the Earth was covered in ice. And that's how he starts this chapter. So he takes us through this whole process of, we can name some of the scientists that made discoveries, but
they're all Russian and we can't pronounce them.
Right. Well, let me try one of them. Milutin Milankovic.
Like I said,
he's Serbian. So
okay.
Sorry.
The point of his story, though, is it's been pretty recent that we discovered, like, we could drill down into the earth and start to look through the different layers and realize that there's been a lot of difference in climate.
So 19th century. And I guess if I ask you, if you think about the Ice Age, how would you assume that happened?
Well, I've read chapters, so I have a little bit.
Pretend like you didn't.
Well, that's okay.
What's the show on the HBO show everyone watch?
Oh, Game of Thrones.
Winter is coming.
Oh,
yeah, that's what I'm thinking of.
I'm not a Game of Thrones person personally, but I know what you're talking about.
We watched 2 episodes and that was too much.
But the point that he's making in the book is that when they drilled down and kind of discovered that the ice ages existed, they just assumed that it had something to do with, I can't even remember what their thoughts were.
So like an extended winter. So you think about it, and if you think about how the Ice Age would be created, or how glacier would be created, or the ice sheet, in your mind, I guess I picture it's dark all the time. It's constantly cold.
Yeah.
And that's the assumption that we make as humans. And each scientist that dug into this further discovered more and more there was actually one little tipping point that made the difference. It wasn't a harsh winter. It was a mild summer that caused that ice sheet. And
right.
So as they go through and explain that, a moderately cool summer means that the snowpack from the previous winter didn't completely melt.
Yep.
Which then made it colder because the sun reflected off of that. And that just carried forward on and on and on and on. And that's actually what caused the ice sheet, not an extended period of winter.
Yeah.
Which is not even close to what I would guess most humans would think.
Yeah.
Through.
And just as important to that story, it took a lot of time. It was a lot of years. It didn't happen overnight. Now, we have a couple of practical examples of this as well before we get back to Warren Buffett. When it comes to compounding and understanding the impact of compounding interest or just compounding of anything, one of my favorite stories to tell is the piece of paper. I've been telling the story since I got into financial services. It was one of the first kind of principles and types of anecdotal type stories that I'd heard. And it just stuck with me because it blew my mind. And that is, if you took a regular sheet of paper, an 8.5 by 11 sheet of paper, and you fold it in half, it obviously doubles in width. And then if you fold it in half, it doubles again. And if you fold it in half, it doubles again. Keeps going, going, going. Now, it's only humanly possible to fold the piece of paper 7 times because then it gets too small and you can't do it. But hypothetically speaking, if you could keep folding the piece of paper, how many folds would it take so that the piece of paper it wouldn't be in your hands anymore, was thick enough that it reached the moon?
I know the answer now.
You looked it up?
I did. He was going to stump me.
He had forgotten.
I had forgotten. I took a guess, but it's 42.
The answer is 42.
Yeah.
Yeah. And so if you think about it, at 40 folds, you're not even out of the atmosphere, the world's, the Earth's atmosphere.
That's crazy.
At 41 folds, you're obviously halfway to the moon. And then at the 42nd fold, if you're halfway there, the last fold gets you half of that distance.
Yeah.
The other kind of anecdotal story is the whole lily pond.
I do not know this one, so you can stump me all you want on this.
We did read it a little bit, but the story or the riddle goes that if a lily pad on a pond doubles in size every day, and after 30 days, it completely covers the pond, on what day does the lily pad cover half of the pond?
I think anyone would guess around 15.
Yeah. Makes sense, right?
Yeah.
That if it starts and then it doubles in size after 30 days, it covers the entire pond. Around day 15, it covers half of the pond. But that's because our minds think linearly. And so we think of like 8 plus 8 plus 8 plus 8 plus 8, or, not 8 times 8 times 8 times 8. That's a much different thing. That said, the answer is actually day 29. So now you think about it, like if it doubles every day, the second to last day, like the piece of paper, you're half the pond. And then on day 30, you get half of the way there. What's interesting to me, though, isn't that. What's really interesting to me that on the guess of day 15.
Yeah.
That at that point in time, at day 15, the lily pad would only be covering.
Wait, I think you should do a dramatic pause and let people guess. Write it down on a piece of paper, and
there you go.
And boom, we're going to tell you.
Yeah. So 5, 4. We need Jeopardy music.
Dude.
Yeah. Yeah, do it.
I don't really know.
On day 15, the lily pad only covers 0.0031% or 0.003 of 1% of the pond on day 15. And it only crosses 1% of the pond on day 24.
I was way off.
Samsonite. So both of those stories kind of, go to this fact of, Warren Buffett took him from age 10 to age 65 to accumulate $3 billion. And then from 65 to 92, another 115 or 118 billion.
That's bonkers. The other comparison that he talks about with Buffett, which I think is super fascinating, is, well, number one, you know the answer to this already, but the other illustration that they go through in this, the little thought experiment, is if Warren would have, at age 60, decided to retire and go play golf and spend time with his grandkids and not continue active investing from that point forward, what would his net worth have been?
Well, and to be fair, he would also have not started saving at age 10.
Oh, yeah. So,
right. If he would have started like most normal people in his 30s and then retired in his 60s, and not only had he been saving, but Warren Buffett historically in his investing career has averaged a 22% rate of return.
very impressive.
So it's very good, like better than 99.9% of investors. The S&P 500 index, which still beats the average lay investor the vast majority of the time, is just shy of about 10%. And Warren Buffett,
more than double.
More than double. So even if we give him his rate of return, but he didn't start at age of 10 and he retired at his age of 60, or does it say he starts at 10? Yeah, no. What if he had been a normal person, spending his teens and 20s exploring the world, finding his passion? By 30, his net worth was 25 grand. Then at that point, he went on his extraordinary run of 22% annually, and then retired at 60 to play golf. He would not be worth $84.5 billion. We all get that. How much would he actually been worth, his net worth at that point?
11.9 million.
Which still sounds like a big number.
Right. But that's 99.9% less than his actual net worth as of that date, which is even less.
So time, he is a very skilled investor, but as Morgan says in the book, his secret is not that. It's time.
Yes. And of that small percentage of people that he has not beaten, there's a really good example in here.
Yes. So he does give another example of something. So like we would all like a better rate of return, right? Sure. And chasing rates of return. And so he gives kind of the extreme example, the guy that's basically better than anybody in history over a long period of time. And he mentions a gentleman by the name of James Simmons. James Simmons, if you're unfamiliar, was a hedge fund manager, and his fund was called Renaissance Technologies. And since 1988, Matt, what average rate of return does his fund have?
Just 66%.
Just 66%.
Just 3 times. Just 3 times.
That's it. More. That's all it is. And as the time that Morgan wrote this book a couple of years ago, his net worth was $21 billion, 1/4 of what Warren Buffett's is. Now, if James had started investing at the same time that Warren did and kept investing as long as Warren has and earned his 66% rate of return, he would be worth, wait for it. Hold on, it's going to take a second. He would be worth,
take a breath,
63 quintillion, 900 quadrillion, 781 trillion, 780 billion, 748 million, $160,000. That's it. The richest person in the world today is Elon Musk, as of us recording this podcast. And I think the last time I saw his estimated net worth, it was like 219 billion or some ridiculous number. This is a lot more than that.
Yeah, just a bit.
In fact, there's 9 more zeros in this number than a $100 billion, $200 billion number. And that's because if you take time and you add it to the success that he's had, that's what happens. And so yes, rate of return matters, but not nearly as much as time.
Right.
I think we've proven the point.
I believe so. I think I would agree.
Let's do one more.
All right.
So I brought up the 8 plus 8 or 8 times 8. So if you had to calculate 8 plus 8 and there was 7 8s, 8 plus 8 plus 8 plus 7 times. What's 8 plus 8 7 times over?
56.
That's correct. What's 8 plus 8 9 times over?
72.
That's correct. So you can do this because it's all plussing. What's 8 times 8 9 times over? If 8 plus 8 9 times over is 72, what's 8 times 8?
134,217,728.
Cheer. Isn't that crazy? So addition, linear thinking, you get 8 plus 8, 9 times is 72. 8 times 8, 9 times is 134 million and some change.
That's crazy.
That's the difference between addition and compounding. Timesing is compounding. So compounding really, really matters. And compounding's bestest friend is time. All right. So we drove the point home. Now what do we do with it, man?
I think I love this line. None of the 2,000 books picking apart Buffett's success are titled, "This guy's been investing consistently for 3/4 of a century." Maybe we should write that book.
We should probably write that book. Sorry, Morgan. I didn't write your book, but I'm going to write that book that you suggested. I'm not going to write that book.
And he goes on to summarize that further and say, one of the best titles of a book might just be called "Shut Up and Wait."
2,000 books have been written about Warren Buffett and his success. That's nuts.
That's
absolutely.
crazy.
Well, and it's not that you shouldn't write books about Warren Buffett and that he did nothing correct other than just have time on his side. But Morgan's point is that is the number one thing he has to get to where he's at.
Yeah.
Right. And so again, boiling this down, let's go to the negative side of it. Knowing this, what do you see, Matt? I'm putting you on the spot here.
Mm-hmm.
The number one mistake people make when it comes to investing.
Yeah. I'm going to put a positive spin on it a little bit, but I
said, what's the negative thing? You said I'm going to put a positive.
Okay,
I was going to go positive next. Okay. I'm going to give you that opportunity.
Okay. I'll do negative.
Okay.
Negative would just be patience. I think it's letting things play out the way that they will and not thinking that we can outsmart the power of compounding.
Yeah. I think a way to summarize that would be emotions.
Yeah. Take emotions out of it as much as you can, or find a way to do so.
Yeah. And I don't want anybody to take this the wrong way if these are thoughts that run through your head, because I think it's natural for everybody to have these types of thoughts. But Matt, one of the comments we get from people a lot, and it's not the same specific thing, but it's always pointing to where we're at in history, kind of what's going on right now, and having the thought process of, well, this is different. I need to react to X because this has never happened before. I don't like what this political decision was made, or, this war that's going on, or this or this or this. And because of these things, I want to react differently.
Yeah. You know what I wish we would do, or we had done at this point?
Are you putting us on the spot here?
Yeah. Well, we can't go back in time, but this might be something really cool moving forward. There's always a short list of those things.
Yep.
Whether it's,
war in Ukraine.
Inflation. First version of COVID with SARS.
Yeah.
Had the conversations we convinced SARS was going to change. So there's always a short list of things to be scared about.
Yep.
No matter at what point in time we choose.
Yep.
I don't care when it is. I think every quarter we should make the short list and just go back and look at it and go back and show people, hey, this is what was going on.
Yeah.
This was the short list of scary things at this point. Now, sometimes we're going to see it more often, but that's one conversation I've found myself having over and over again is it's often, and I'm not saying I don't do the same thing, but as humans, we think, oh my gosh, it's different this time.
Yep.
But the reality is there's always that short list. There's always the things that are different and things are always going to change. So,
yeah. It's interesting you say that, because one of the books that Morgan references in his book, and once I read this book, I've listened to multiple podcasts now and other types of stuff where I've found him being quoted. And one of the books he references it's called The Great Depression, a Diary. And it literally is the diary of a lawyer that went through the Great Depression. And it's for years. Like, this guy wrote this diary for years, and the book is literally just his writings. And of course, you gain a ton of perspective, because when he's writing in the middle of the Depression, you can about imagine the sentiment and the thoughts and the world is burning, mentality of we're never going to be able to recover from this. It's the worst it's ever been. Like, it's never, just all of that kind of stuff. And the psychology that goes along with being in it in that moment, because you always have that thought of, well, nobody understands. It's never been like this. What are we supposed to do? So anyway, that is the negative side of it for sure. Because when we get in when we have this list, and there's always this list, to your point, that's a great way to think about it. Do we react differently? Do we try to do something different? Or do we remain patient as an investor in what the true definition of an investor is?
And that doesn't mean that we're not going to adjust strategy according to what's going on, but it's just understanding that we are expecting that's going to happen. There's going to be another list next year and the year after.
Right.
And the year after.
Well, and to quote the gentleman that Morgan uses as his prime example, Warren Buffett, he says the keys to success are to get invested and to stay invested.
Absolutely.
And so it's not lost on Warren why he's so rich.
Right. Exactly.
He's had 3/4 of a century to get or become that rich. So what about the positive side of it? What can we take away from this?
I was going to take it to say if you weren't going to. Right. I was getting a little antsy. I'm a glass half full type of guy. So one point he brings up in here, which I think relates, is just the example of how one small, tiny action can have a compounding effect. So a great example of this, which I can actually share in a real life scenario, is, and I'm not going to name clients, but the client that we had a conversation with that that I had just introduced someone to, we did one small thing, 12 years ago, to change some of their spending and saving habits, which has just skyrocketed their financial picture. And it was one tiny little small change that has made all the difference and changed their path. And all it was us helping them set up some sort of budgeting system.
Yeah, I think I know what you're talking about.
Yeah.
Yeah. For me, it's similar. I think the positive thing you take away from this is, like a lot of coaches say, trust the process. If you want to be an investor, you have to trust the process. If you think that the markets are going to fall apart at some point, you should never get into them in the first place. Like literally, just don't even, because you're not going to have the benefit of time, because at some point you're going to end up pulling your money out. And history and study after study would show you that the odds of that working out in your favor and knowing when to go to the casino and when to leave the casino are not good.
Right.
There's a reason that the casino is full of marble and, they're really nice buildings and the people that own them are super rich. And it's not because the majority of people that walk in there win. Right. And if you treat the market that way and you're going to invest, when you think about your kids, when we use like similar language of, I'm going to invest in my kids. Think if you treated your kids the same way that you treat the markets, and you're like, well, the winds of change are coming and they hit puberty and they're a little bit different animals. So I think I'm out.
I'm bringing this up. Calling in reserve.
I'm going to cash. I'm not going to invest anymore. We know with kids, it's for the long haul. And you have to have that perspective in the midst of having these kids in your house sometimes. But
even when they hit their teens.
Yeah. But time is the greatest asset that you have. Right. And none of us know how much time we have. And so it's one of those, another misnomer as, a human being, an adult human being is, we look at our age relative to kind of the averages. So we're both in our early 40s. On average, we got 40 years left, 40, 45 years left, something like that. So we may think we're halfway done.
We're middle-aged.
We're middle-aged. Thanks, Matt. Appreciate that. I've literally never thought that before.
Neither have I, until I had someone mention something about middle age the other day. And I was like, who are you talking about?
Yeah.
You guys. Wait.
That's kind of sad. Yeah. But it could be that, time-wise, we could be done tomorrow. But we could have 60 years left, right. But at the end of the day, you don't know. And so just because you don't have as much time as you did yesterday doesn't mean you should do nothing. In fact, today is the most opportunity to do anything because you have more time than you do tomorrow.
Yep.
Right?
Yeah. Yeah. Another example of a small little action that I would think of as just starting something. Like even if it's someone started putting $500 a month into a Roth IRA.
Yep.
Like think about, had they not done that over the course of 30 years? And that was one small, tiny little action.
Yeah.
So those little things can crank it out a whole lot.
A lot of the families we work with, when they come in, or if we meet them kind of later in their careers or when they're retiring, and that's when we kind of enter their story, we hear the same thing again and again. I never thought I would have this much money.
Right. Yeah.
And it's because forever their account went from $1,000 to $2,000 to now it's 4,000. Then after a couple of years of saving, when they started saving in the 70s, maybe it hit 10 grand and they got pretty excited, and it took forever to get to $100,000. But then all of a sudden it hit $200,000. And then after 30 years of saving, it hit $1 million. And then the last 10 years of their savings, it went to $4 million.
Yeah. Snowball effect.
Right. Or the lily pads or the piece of paper or pick your poison. And how they get there and they're just so surprised. They're just like, I never thought I would have this much money.
Yeah.
But again, it's because our brains think linearly, not on a compounding basis.
Absolutely.
I have another takeaway. Do you have any other takeaways?
Those are the two big takeaways for me. One, how one small action can make all the difference over a time period, and just the power of time. How it can work on our side or against us, depending on how we approach it.
Now, applying it, there's two bookends here that I would love to just kind of drive point home as we wrap up. And the first one is, you may be older than us, older than middle-aged. Goodness sakes. That's so depressing. It's already almost dark outside. It's cold outside, and now I'm middle-aged.
Heads are falling off.
Oh, man. If you are later in life, you know somebody that's not, right? Your kids, your grandkids, whomever it may be, to help them get going. Take the knowledge that you've gained here and help somebody start somewhere, even if that somewhere is $10 a month or whatever it may be. But Warren Buffett started at the age of 10, and it was because of that he ended up where he was at. I actually went through this exercise. After I read this book, I went through this exercise with my boys, who are now 12 and 9. And so maybe they were 11 and 8. It's been within the last year. And it blew their minds because they were talking about the little bit of money that they do earn, at 12 and 9 years old. And they're like, it doesn't matter. It doesn't make a difference. And I started going through compounding interest with them and blew their minds. Just completely blew their minds. So is to impart this knowledge on somebody that's younger than you to have a positive impact. That's number one. Mm-hmm. Number two is one of the biggest mistakes I see retirees make when they get, they 55, 60, 65, 70, whenever it is that they're retiring, and they look at their net worth at that point in time. And a lot of them are in that boat that we were talking about, where there's like, I didn't think I would ever have this much money kind of deal. Even if that much is $200,000, they still never thought they would get to that point, or it's 10 million. Doesn't matter what the number is that if you retire at 65 and your money continues to grow, and a lot of the families we work with tend to spend very frugally in retirement, because usually the ones that have significant money were frugal in their working years. Right. So that frugality doesn't just stop on a dime. In fact, usually it gets worse.
Right. Yes.
Because now you're not living off the paycheck you earned. You have to live on your own money. And so all of a sudden, the compounding effect of frugality kicks in, and people tend to not spend their money. And when you have somebody that's worth, net worth, investable assets of $5 million at 65, if that doubles a couple more times over their lifetime, the 5 becomes 10 and the 10 becomes 20. And so, at their age of 65, we start to have these conversations of, well, look, what happens? Like if we just can kind of let the train continue to roll down the tracks, at day 15, 0.003% of the pond is covered. At day 24, we're only at 1%, but you're in that last 6 days of the pond growth of your life. Yep. This is where it starts to take over, and the lily pad starts to cover significant areas of the pond. Here's what's going to happen to your piles of money. And that changes the planning trajectory massively. Yep. And honestly, Matt, I would say the majority of our industry and our peers don't think this way. No, they don't realize this. Estate planning attorneys build estate plans for 65-year-olds based on their net worth today without any thought to what's coming and how this compounding effect is going to take off in these last handful of years. And it's those last pieces of paper, it's those last days in the pond that is what is in front of you. Right. And we need to plan for that appropriately. So it's both on the bookends of that, or the barbell ends of the portfolios of very, very early and very, very late, being cognizant of what compounding means.
Absolutely.
I think we did it. We're going to tease the next one, though. We always tease the next one. So the next time we come back to the psychology of money, we're going to get into chapter 5. So let me tease it by reading you the last sentence of chapter 4. It says, well, let me get a couple last paragraphs, give you some context here. He says, but good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that can't be repeated. It's about earning pretty good returns that you can stick with, which can be repeated for the longest period of time. That's when compounding runs wild. And then he ends by saying this: the opposite of this, earning huge returns that can't be held onto, leads to some tragic stories. And that is what we're going to discuss in the next chapter.
Yes.
So chapter 5 is called Getting Wealthy versus
Staying Wealthy. Good investing is not necessarily about making good decisions. It's about consistently not screwing up.
Much easier said than done. He makes a lot of points in here about it's actually harder to stay wealthy than it is to get wealthy. So we're going to dive into that in the next chapter. This book's a ton of fun. Hopefully you're enjoying going through this book with us. And thanks for joining us in another episode of Every Day is Saturday. If you want us to have conversations with anybody that you know, especially if it's like kids or grandkids, this is actually super fun for us. We've done this quite a few times in trying to impart some of this knowledge on the younger generation. If you want us to help be that outside counsel and have these types of conversations of why it's so important to get started early, we would love to. Get a hold of your advisor here at Fiat. We can start some of those conversations for you. So there's your call to action with the knowledge that you learned today.
Yep.
But also, if you're in that 55 plus crowd getting near or in retirement, be very cognizant of where you stand today and the fact that, you may not be Warren Buffett starting with $3 billion at age 65 that then turns into $84 billion. But even if you're at 300 grand and it's going to compound by then to 85, if you're earning good returns and not spending a lot of it, what that can do and how you need to plan for that later in life. So thanks for joining us on this episode of Every Day is Saturday. My name is Brad Gatto. Again, here with my partner, Matt Stahl. If you want to subscribe to the podcast, we would love if you would do that greatly. And you can all find more information about Fiat on our website. That is fiatwm.com. That's FIATWM.com. Everything you want to know about Fiat and a lot of stuff you probably don't want to know. It's all on the website. Check us out there.
It's all there.
See you next Saturday, everybody.
Thank you for listening to Every Day is Saturday. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Fiat Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.